When it comes to picking mortgages, you're going to be presented with lots and lots of different options. Most of them will go completely over your head because there's just so many to choose from. But this video will help you go through and explain the basics of what a mortgage is and how it's all worked out. So first of all, you need to pick your overall term of the mortgage. So if you're a first-time buyer, typically you're going to be that much younger. So what most people do is they pick a mortgage of maybe 30, 35 years. So that's a very long period to pay off the mortgage. But the upside to that is your monthly payment is going to be much lower. Now you could choose to have that period brought down to 10, 15, 20 years, whatever you wish, which obviously means you'll pay your mortgage off much more quickly, but your monthly payment will be a lot higher. Next, you can choose your promotional period. So the bank will give you a rate, which they refer to as promotional rate, and that will be on a deal for so many years that you can choose. It could be 2 years, 3 years, 5 years, or 10 years, and then normally after that period, the rate will then change. Next, you can decide whether your monthly payment is fixed for that promotional period. So it means your monthly payment is fixed, guaranteed for instance, 3 years. So every month, your monthly payment every month your monthly payment will be the exact same. Or you can choose variable, which means it could change over that promotional period. The final option is you need to factor in any penalties. Now, if you pick a promotional period and you say, for instance, it's 3 years, and you decide, well, maybe I'm going to sell my house, or I'll move away from that lender, or the circumstances have changed, unfortunately, the bank will penalise you for getting out of that contract early. Now, finally, rates, interest rates. Interest rates is completely set by ultimately the Bank of England. So the Bank of England oversees every bank in the United Kingdom. They set a rate that they lend their money out to all the different high street banks, and then the banks set their rate that they're going to lend the money out to you. Now, every month the Bank of England meet and they decide what their interest rate is going to be. And then from that, as those interest rates change, then the bank will change their rates as well. So to go back to what I said earlier, a variable rate or a fixed rate, if you choose a fixed rate, that means it doesn't matter what the Bank of England does, your monthly payment stays the exact same every month for your promotional period. Now, if you choose a variable rate, that will be linked to the Bank of England's rate. So typically, if the Bank of England increase their rate, well then the bank that you're lending from will increase their rate as well. It'll never go counter to each other. But if Bank of England reduces their rates, well then your bank who's lending the money to you will reduce their variable rate as well. So it's a lot of options to consider, and you simply hopefully have to foresee what your circumstances are going to be for the future, and you try and pick one that suits your circumstances as best as possible. My name is Dougan. Keep following me for more tips on the house buying process.